Hello, folks. This is Rusty, and we're going to be starting a webinar in just a few minutes. We're just waiting for more people to log on, and then we'll let it roll. Thank you. Hello, everybody. This is Rusty Tweed of TFS Properties. We're here to give you an update on what's happening in the real estate market. We haven't done any webinars for several months for a bunch of reasons. One, we've been very, very busy. We have a lot of transactions going on right now. There's a lot of money moving. We're really the busiest I've seen in many years. Also, there's been patterns emerging, and we've been kind of waiting to see, what's happening. As we all know, there's been changes almost week by week and what's happening between the COVID-19, the election, and everything else. So what we're here to talk about today is what we're calling the big shift. And I'm sure a lot of you are hearing about this already. I'm sure all of you know some friend or family member or somebody that's talking about moving. And so we're seeing a big shift of people reshuffling where they're living to different parts of the country. And so we're going to be talking about what we're seeing happening. First of all, we went around this week, and again, this is actually the second week of December, and we had Clinton run around some areas here in Pasadena and take some pictures. So what you're seeing here is a whole bunch of retail that's empty. I mean, I'm driving around, and I drive through Pasadena every day coming to work, and I'm shocked at how many empty retail spots there are. I mean, everything from, Pilates places to restaurants to little shops. You can't go a block without seeing several places empty and not just, not open right now, but like totally closed. So here's photos, again, all around the Pasadena market. Here's a shot, and this is actually right in Old Town Pasadena. And if you know that area, it's probably I think it's one of the nicest, most thriving areas in Los Angeles as far as a great retail area. And here we are right on Colorado Boulevard, about a block west of Fair Oaks, which is right in the heart of that whole area. And literally all those units you're seeing in front of you right now are empty. practically a whole block of empty retail gone. So this is got to have some kind of an impact in a lot of different ways. One way to think about this too, if you're an investor in any kind of income property, well, obviously having a retail right now is not good. But let's talk about the apartment market. So, you take a small restaurant, even a small restaurant, when you talk about the different shifts of waiters and busboys and the chefs, et cetera, you're probably talking about 15 or 20 employees in even the smallest little restaurant. Well, that restaurant closed down, suddenly all those people don't have a job. And they can only sit around so long. And again, with these renewed lockdowns we're seeing, it's making it really tough for these kind of guys to work. So here we are looking at for rent signs all over the place, again in Pasadena, only this time they're in front of multi-family units. And so, I've driven down California Avenue, Del Mar Boulevard. These are areas where there's a lot of multi-family here in Pasadena. And I don't think I've seen this many for rent signs since back in 2009, 2010, when we had the Great Recession. I mean, if you're going down these areas where there's a very dense multifamily, pretty much every other building right now has a for rent sign out front. So, there's a lot of things going on here. And again, it's not good for apartment owners here in Pasadena and also in California. So what you're looking at right now is a map. And we can thank Marcus and Millichap for putting this together. It's very recent. And what you're seeing here is obviously the major cities here in America. The red dots you're seeing are cities that are shrinking. They're actually losing population. The green dots are ones that are actually growing. I'm sure you've all heard of places like San Francisco and New York City, et cetera. They're having some issues. Well, when those people are leaving those cities, they're going somewhere, right? They're not leaving the country. And so some cities are, like I said, shrinking and some are growing. And that's where we want to take a good look at, see how that's working out. So again, I'm sure a lot of you have heard about what's happening in San Francisco. On the left here, you're seeing a chart showing property values dropping over the last several months. And you can see here that rents are dropping. I was talking to someone the other day, and they know somebody that works at Google up in the Bay Area. And Google literally told all their employees, you know what, you're going to be working from home all through to the end of 2021. Don't plan on coming back to work. And so you think about that for a minute. If you're living in the Bay Area and you've just told that you're not going to have to go into the office for the next year or so, and you've got very, very high rents, because we know that that's one of the highest rent districts in the country, it kind of makes sense. You're probably going to go somewhere else and work from home wherever you came from. Maybe you came from Cincinnati. Maybe you came from San Diego. Maybe you came from Houston. I don't know. But the point is that they're going to go somewhere where it's a lot less expensive. There's more space. It's not as dense, and a place where they feel a lot more comfortable, environment overall. So I think that's what's happening. Here we're looking at New York City. I've got a friend that does leasing in New York City, and he's telling me that the Manhattan area, all those big office towers, he thinks they're about 75% empty right now. And again, these highly dense city areas, people don't just want to go back there. In fact, I saw a survey the other day, and it was actually done by CBRE, big real estate company, and 75% of the people that surveyed that worked in some kind of office tower didn't think they were going to go back to work or wouldn't go back to work for probably another 6 months to a year. And so that's really impacting that environment. People are just saying, look, I don't want to go in an elevator with 10 other people. I don't want to go in an office where there's 100 other workers that I'm going to be bumping into all day. And so I think that the office, or the very big office market where it's very densely populated, is losing a lot of people. And what you're looking at here at the bottom left is rents. And rents have literally just plummeted in New York City. Now, again, my buddy that does leasing there, he's saying that you can actually lease places right now, either office or residential, for less than 50% what those same places were going for at the beginning of the year. So again, New York City is emptying out. A lot of people are leaving. But again, those people are going somewhere. Here we're talking about California. As you know, they've renewed the moratorium here. It's pretty draconian, to be frank. And so I realized that we have a big spike in the coronavirus, and that's very unfortunate. But this moratorium on people paying rents is really, really affecting landlords. I had a client in the office literally just days ago, and unfortunately, this poor man has 5 tenants in a building. He's got 5 units, and not one of those tenants is paying rent right now. He went to his attorney, and the attorney said, there's nothing we can do. You probably cannot do anything until next summer as far as trying to evict them or doing some kind of court order to collect your money. So literally, this poor man is looking at going at least 1 year, maybe longer, with no rents on his 5 units. And so we're starting to hear more and more stories like that. Fortunately, the vast majority of tenants are paying, but you do get some that don't, and it's a big, big problem. Also, rents we're now starting to see dropping in Los Angeles. These are all recent articles that we pulled literally from the last 30 days. And as you saw, those pictures we showed you in Pasadena, people are leaving and the rents are getting more competitive because, again, you're getting vacancies. Those same areas, literally at the beginning of this year, you had trouble even finding an empty spot, and rents were going up quite a bit. But now the opposite's happening. There's more and more vacancies. Landlords have to lower their rents in order to attract tenants. And so we're definitely seeing a big shift here in Los Angeles. Here's a great quote, actually. Richard Burton, who's the CEO of Zillow, and he's talking about what's going on. The U.S. real estate market is starting to show signs of a big reshuffle as people move to homes with more privacy and space to make it easier to work from home. I believe we're on the cusp of a big reshuffle. I'm sure I don't need to explain it to you because we all experience it. We spend an average of 9 more hours a day at home. Zoom meetings are changing the way families perceive space and privacy. Home offices are in high demand. Backyards are more attractive than parks and gyms. And again, I'm sure you're all running into this with people that you know. And I know this is happening. I've had several friends move since the beginning of the year. One of my friends was living in Marina del Rey. Right when all this COVID-19 stuff happened, he sold his property there, actually got a great price for it, and moved to Florida. Another good friend of ours, him and his wife moved this August and left town. We're seeing things happening all around that are kind of shifting. And again, a lot of it is people are going, look, I don't need to live in the big dense city where there's a lot of issues that I'm worried about. I can go to somewhere else where, I can buy a much better property for the same price or less, much bigger property. And we're seeing just a lot of things happening. Another example, personally, we owned a second home up in Park City, in Utah, and we were not planning on selling it. But just in the last month, we got an offer on it that was much higher than we ever expected that we would sell it for. And so we made a family decision to sell it. And it just closed last week. But again, Park City is one of these areas where there are a lot of people are moving, and it's gotten attractive because everything's going on and the prices have been pushed up. Again, I'm hearing stories. A friend of mine, I went fishing with him in Montana a month ago. And in Bozeman, Montana, we were talking to the guys there, and they're saying the average home just in the last couple months in Bozeman has gone up $90,000. And that's in a market where homes were $300,000 to $400,000. So again, if you ask around or whatever, I'm sure a lot of you are hearing examples of things like this happening. My stepson lives up in the Santa Ynez area, north of Santa Barbara. That market is just booming. Properties have probably doubled there in the last probably couple of years, but especially this year. And again, it's a nice, kind of rural area, and people are trying to get out of the big city, and that's a very attractive spot. So again, it's just happening all over. So to give you guys some kind of hardcore data to look at, we like looking at U-Haul. And so we took some examples here. Here's one that if you went and rented a U-Haul truck and you wanted to go from Los Angeles to Austin, Texas, how much would it cost you? Well, it would cost you $2,665. But guess what? If you rented that same truck, only this time you're going from Austin back to Los Angeles, guess what? It's about 1/4 the price. It's only $700. Big, big difference. Now, why are we looking at this and why are we talking about U-Haul? Well, obviously it's expensive, to rent the truck to go to Austin, but it's a lot cheaper to come back, which is telling us that there's a lot more people going to Austin from California. And U-Haul wants to get those trucks taken back to Los Angeles, so they're willing to rent them out for literally 25% of the cost it takes to get there. And so that allows them to get people to take the truck back to Los Angeles, and they kind of cycle through this all again. But that's a pretty dramatic difference. Here's another one showing going from Los Angeles to Houston, Texas. Here it's pretty similar. It's about $2,800 for that one-way trip. If you're going from Houston back to Los Angeles, it's less than half. It's about $1,300. Now, for the heck of it, we said, okay, what happens if you were to rent a truck and go from New York City to Indianapolis? Well, in that case, it's going to be close to $1,400. Taking that same truck from Indianapolis back to New York City, only $500, about a third the cost. So again, there's a lot more people going from New York City than there is going back to New York City. Here's another one. If you were to take a truck from New York City to Tampa, Florida, it would cost you about $3,200. Going from that same truck, only going from Tampa back to New York City, wow, look at that. It's less than 20% of the cost. It's only $600. Huge differential there. So again, this is telling us that there's a lot more people leaving New York than there are coming into New York, and then that's why the big change in prices. So again, if you want to kind of check out a city to see whether it's growing or shrinking, and you pick two markets like this, it gives you a pretty good idea of what's happening. Now let's look at home prices. Now, we can't do this for every city. We're picking cities that we've been involved in, and we're redoing properties ourselves. But if you were to take a look at the prices of homes in Texas, Houston, Texas particularly, from January this year to October, their median home price in Houston went from $270,000 to almost $310,000, which is a 12% jump. Now remember, these prices have gone up this much during COVID-19 and the lockdowns and everything else. So again, that's telling us that there's a lot more people moving into Houston than are leaving. You take homes in Indianapolis, which is again another market we do a lot of activity in. At the beginning of this year, the median home price in Indianapolis was $160,000, and that's gone up 13%, and today it's $184,000. So again, a big jump through all the market that we've been through. Beaumont, Texas, which is another market we're going to talk about in a little bit, same thing. Houses from the beginning of this year went from $170,000 median price to $190,000. So again, we're looking at some markets where people are leaving, but those people have to go somewhere. So a lot of these Midwest and Southern markets are seeing a big inflow of people from the bigger cities. And again, this map kind of shows that pretty clearly. Again, we're looking here in Southern California. Most of the cities are showing red, which means they're shrinking. Inland Empire, surprisingly enough, is actually growing. I think that's because it's so inexpensive there right now. A lot of people are moving there. But you can see here, Vegas, Phoenix, Dallas-Fort Worth, pretty much every city, well, I'm sure every city in Texas right now is showing very strong growth. So is Florida, Atlanta, Georgia. And again, we do a lot of stuff in Indianapolis. So you can see that's yellow, which means it's growing, just not as much as the green. But again, the whole north area here is pretty much red and shrinking. So this is giving us a pretty good insight as to what markets we want to be in and what markets we don't want to be in. Just to give you an example, this is a transaction we just closed on in the last 30 days. And so this was a client of ours that had a non-performing asset here in Arcadia. He actually had a restaurant that he owned, and he owned the building that it was in. And probably 5 years ago, he sold the restaurant and kept the building. Well, unfortunately, earlier this year, when everything was going crazy, his tenant actually called him up and said, hey, I'm sending you the keys. I can't stay in business. I'm shutting down. So unfortunately, the business closed and he was stuck with a vacant building. The good news is there was a developer that really wanted to buy it. So he did get a good price for it, not as good as he would have before this, but he got a decent price. He sold it for $2,800,000. We did a 1031 exchange. He actually bought a beautiful brand new building that we found in Reno, Nevada. And Reno is actually booming right now. In fact, you can see the Tesla building in the back there. Tesla is just booming up there. They talked about hiring another additional 3,000 employees just for that Tesla plant. It's very big. They're talking about it when they're finished. It's going to be around a $6 million square foot factory, monstrous. And most of the tenants in this building you're seeing here on the left were actually employees of Tesla. In addition, we bought a portfolio of single-family manufactured homes. His blended return on those two parts of his portfolio was over $208,000, which put him at a 7.5% cap rate. So again, you know, he came out of an asset here in Los Angeles that was non-performing. We put him in these other assets, and he's a very happy camper right now with some really, really good income. So let's just talk about some of these other markets that we're dealing in and we're very familiar with. Houston is a great city. We've done literally hundreds of properties in that area. We've done everything from triple net lease properties to multifamily to manufactured homes and single family homes. Now, just to kind of give you a little bit of background here, we made the decision about 4 years ago that at some point we were going to have a recession. We were starting to look ahead, and believe me, I've been through several recessions before, and they're painful and they're brutal and they're not fun at all. So we really wanted to pick some markets around the country that we could get very familiar with, do a lot of business there. And we wanted to pick markets that we felt were very stable so that when we did have the next downturn, it would be very minimal for us. So Houston was one of those cities. And like I said, since then, over the last 4 years, we've literally done several hundred properties there, and we're very, very familiar with it at this time. And we're actually very happy we've been in this market because, as you can see from the earlier chart, things are doing well here despite all the things that are happening with our economy. So the main thing we're doing here right now are these manufactured homes, and we have an arrangement with a company that is one of the largest owners of manufactured home parks in the Houston area. You can see this map, but virtually every one of these red dots you're seeing are parks that we've actually been involved with, and you can see they're all around the Houston area and suburbs. And so what we're doing there is we're having investors buy these individual units, and they come with a tenant in it, and they're managed by the company that owns all these parks, and they even come with a maintenance contract. And so your net income on these assets is about 11 to 12% cash flow, and that's after all the expenses. And the average price for these is around $50,000 a unit. So we've had clients buy one. We had one client in the other day who bought 22 of these units earlier this year. Out of those 22 units, she only had one vacancy, and it was only vacant for a matter of weeks. The rentals in this market right now are very strong. And again, we're kind of going over this kind of fairly quickly just to give you guys, you know, kind of an idea of what we're doing. If you're interested, please call or contact our office. But here's just running the numbers here. Like I said, it's around $50,000 a unit. By the time you take all your expenses away, you're netting out, in this case, 11.5%. And that's pretty common for the types of properties that we're doing there. We used to do property tours, which were a lot of fun. Usually about once a quarter, we would take a group of investors and fly out to Houston and drive around and look at the parks we did. Unfortunately, with what's going on right now, we can't do that. But we will be doing that again when we're allowed to and when it makes sense. So I look forward to that. If you do want to get more information, if you go onto our website, there's actually some very good videos of these property tours. Or if you're interested, you can contact us at the office. We can send you out more information. Now, let's talk about Beaumont, Texas. Now, this is another interesting market. It's a unique pocket, which is about 2 hours east of Houston. And the interesting thing about Beaumont is, and you can see a picture in the bottom, they're actually building out the largest oil refinery in the entire world. Huge. And that's an existing refinery that they're adding to. It's Chevron and Mobil that are doing it. And it's just a huge, huge project. In addition to that, and it's a little hard to see in this picture, but you can see right in here, there's actually an inland port right here. And right now, they're taking that inland port and they're expanding it, making it into a deep water port for the large super tankers. And so the amount of activity right now in construction here is just over the top. The job market is fantastic. There's people moving in from all over. The rental market is awesome. We had a client, in fact, we just closed on one of these properties on Monday, but last Friday, that property had lost its tenant. while we were in escrow, and literally over the weekend, they got a new tenant in there. And that's pretty common there. Literally within a couple of days, you can get a new tenant, and quite often you can raise your rents. That's how busy it is there. The kind of properties we're doing there are these single family homes. Again, this is Texas, so the properties are a good size. They're anywhere from 1,800 square feet to 2,400 square feet, good sized lots. We're working with a owner actually that's here in Los Angeles, and they have a portfolio of 150 of these homes. These are all off market, and he's given us access to this portfolio because he wants to sell some of these units off because he needs to buy another property he's working on. And so again, if you're interested, these properties have all been totally renovated. They have tenants in them with a lease. They have a local management company looking after these. They end up being about an 8% cap rate, and that's if you paid all cash for these units. They're anywhere from $100,000 to $200,000 a property. If you get them financed, it's probably going to come out closer to 12 or 14% cash on cash return. And as I showed you in that chart earlier, there is some good appreciation happening in that Beaumont market. But yeah, we actually just closed on 4 of these units just in the last week for clients, and we're doing quite a few there right now. Another market that we're dealing a lot, and we showed you some information earlier about Indianapolis. We love Indianapolis. We've been doing a lot of business there for the last 4 years. Again, we've done all kinds of properties there. We've done Pizza Huts, triple net lease. We've done some industrial buildings with triple net leases, and we've done a lot of these single family homes. Now, again, why would we pick Indianapolis? Well, the thing about Indianapolis is it's nothing really great happens there, but nothing really bad happens either. We really wanted to pick markets that were very stable. So if you look the track record of Indianapolis over time, like I said, you don't see huge appreciation, but you don't see a lot of downside either when the markets or when the economy's not doing well. So that's why we picked it. Just good, stable, strong growth. Indianapolis is actually a fairly big market. If you include that whole MSA and the suburban areas and the towns close to it, it's the 17th largest market in the United States. So it's not huge, but it's certainly not small. And again, it's very, very stable. Here we're doing these smaller single family homes. They average about $90,000 a piece, which seems dirt cheap for us guys here in California. But these things cash flow are about an 8 or 9% cap rate. And so they're very good. Again, they're fully renovated. These properties we're doing are totally off market. We're working with a friend of ours, Michael Drew, who's been in this market now for about 10 years. And we've done well over 150 of these homes with him over the last 4 years, and our clients have been very happy. Now, some people ask us, look, why don't I just go buy a 10-unit apartment building in Indianapolis or some of these other markets we're talking about instead of buying all these single-family homes? Well, believe it or not, we've actually done that, and we've gone after properties for clients in these markets. We were after one, actually a very large apartment complex in Indianapolis ways back. And right now, all across the country, everybody wants to buy multifamily. It's very, very competitive. Prices in multifamily have pushed up quite a bit. The cap rates are very low. The average cap rate on good quality buildings right now, multifamily, is around 5% across the country, believe it or not. Once in a while, we can find a good deal for a client, but the truth is that the cap rates are low and it's very, very competitive. Now, if you compared that to buying 10 single-family homes, you're going to find that the cash flow is almost double what you would get if you bought a multifamily. And the other thing is we think that there's much more upside on these single-family homes than you would get on a multifamily right now. And the reason is rents have to go up quite a bit for the multifamily price to go up, whereas homes are a little different. People moving into a city like this, which they are, is pushing the home prices up. And as I showed you earlier, homes in here in Indianapolis have gone up 13% since the beginning of the year. And we think there's a lot more upside. I mean, let's think about this. If you're buying one of these houses for $90,000 or $100,000, a lot of people can afford that. And so we think that that's going to keep happening as a trend. So again, we think it's much more beneficial to buy 10 single family homes than it is to buy a 10-unit apartment building. The numbers work out much, much more in your benefit. As well, we have good management. Now, any market that we're dealing in, we want to make sure that there's good management, because the worst thing in the world is going into some market out of state and you can't manage that property very well on your own. And if you don't have a good manager in place, then as you all know, it's a big problem. But again, we have good management in place. Look, nothing's perfect, things come up, but if there is, give us a call. We do a lot of business with these guys, so they respond when we call them. And so again, we have a good team in place here. Here's just a typical home that we did. It's one that we closed at the beginning of this year. Our client bought this for $80,000. Again, it's totally renovated. It had a tenant in place. Once you get all the expenses peeled out of this, this was about a 9% net cash flow to the investor. And then in this case, the investor bought it for all cash. But you can get these financed, and you need to put about 35% down to get them financed right now. Okay, so as we all know, we're in the coronavirus world. It's very unfortunate what's going on. We had a major wave earlier in this year, which was a big shock to us all. Things seemed to get better, but then we had another second wave of it, and we're in the middle of it right now, and it's not fun at all. And we're seeing more and more lockdowns, more and more businesses going out. But as I explained earlier, 3 or 4 years ago, we decided to take a defensive strategy because we knew that at some point there was going to be recession. You can only have an affluent market for so long. Generally, about every 7 years we have a downturn. This one went a lot longer. It went well over 10 years, since back in 2009 when we had the Great Recession. We had no idea there was going to be a virus like there is. But in this case, that was the triggering event that's obviously given us a big problem on the economic side of things. So the defensive strategy that we've been using for the last 4 years has worked very well. We've stuck to markets that we felt would hold up. But we've also stuck to properties that we felt would hold up very well. So I'm going to turn this over to Edward in my office, and he's my right-hand man. And Edward's specialty is triple net lease properties. I'm going to have him walk you through some of the properties that we've done recently and how they've been holding up. Over to you, Eddie.
Thank you, Rusty. As Rusty mentioned, my focus within TFS Properties is identifying and sourcing great deals for our clients. And through a series of case studies, we're going to be going through multiple scenarios that our clients have transacted upon, whether it's through a 1031 exchange or just a straight cash purchase and investment. The first case study we'd like to run by is the client that Rusty had mentioned earlier in our presentation, a nice elderly couple who had a restaurant out in Arcadia. The tenant unfortunately went underwater, and the clients decided to sell their building and do a 1031 exchange. Once tasked over to me, I decided to look on the internet and see if I could find good deals within the Reno, Lake Tahoe market. That was a geographical area that the client was specifically targeting, and we were able to find this brand new apartment complex in downtown Reno, and we negotiated it from a high 5 cap to just over a 6.25 cap, which is unheard of for brand new multifamily property. With the remainder of the net proceeds, the client decided to allocate it into 13 manufactured homes in Houston, Texas, which created an overall blended return of just over 7% unleveraged. The client was very happy with that exchange and is benefiting from the cash flow today. In our next case study, one of our clients had sold some stocks and decided to park some of her money into a triple net lease asset instead of leaving it into her savings account and accruing very little interest. From there, we were able to contact many brokers within our network, and we found this Popeyes located in Riverside, California, adjacent to a McDonald's. And the other benefit of this location was that there was an elementary school right across the street. So you can imagine lots of kids going to and from the restaurant, and also getting high traffic counts from being on a major retail thoroughfare such as that McDonald's would want to be on that same street as well. This property, being in California, was negotiated from a 4 3/4 cap to a 5% cap rate, and had a brand new 15-year triple net lease. The operator was a large Popeyes franchisee based out in the Dallas-Fort Worth area, and we were able to acquire this property brand new for $2.8 million. The next property came from a 1031 exchange from a longtime real estate investor who wanted to pivot out of multifamily. Him and his father had acquired over the last 40 years a substantial amount of multifamily units, and dealing with Section 8 tenants was just something that was no longer his forte, nor did he have the patience for, to be frank. With his 1031 exchange, he sold a triplex that was generating about 3.5% net cash flow based on the sale price. And we were able to find and source a property out in Texas, which has no income tax. And we found a brand new Wendy's in Sweetwater, Texas. And it was negotiated from a 5.5 cap to a 6% cash flow and had a brand new 15-year triple net lease. And the purchase price on this property, $1.7 million. And client's very happy with that exchange, knowing that he now has a 15-year tenant as opposed to dealing with year-to-year turnovers from his current or his previous California tenants. Those of you that have been with us may have seen this transaction before. One of our clients, of which we're doing a 1031 exchange right now, actually, sold their luxury penthouse out in downtown LA just a little over a year ago. And he bought the property for $600,000. We were able to sell it for just over $1 million in less than 2 weeks of marketing this property. Based on the single tenant that was occupying this unit, he was earning a 3.5% cap rate. And what we did with the 1031 exchange was that we decided to diversify into Indianapolis and Houston, and we took the net proceeds and reinvested it into 17 single-family residences that had tenants and was performing since day one. And although he had to give up his sort of pride of ownership asset, we were able to almost triple his income, as you can see in the next illustration. Double his income, as you can see in the next illustration. So with this in mind, as you can see the breakdown of the cash flow versus the expenses, and he's going from $40,000 per year in net income to just over $115,000 in net income. So almost triple, not quite there, but we're very happy with that exchange as well. And so the client's doing the exact same thing with the property they owned in Orange County, and we're going to be doing a similar outfit when it comes time to finding the replacement property. The next client was kind of a unique situation. They had owned a single-family home, what was once their primary residence, but became a rental for just friends and family. And they received an offer from a developer that they couldn't refuse. The property was located out in the South Bay Torrance area, and the developer put an offer for their single-family residence at $3 million, with the expectation that they were going to pretty much absorb the entire block and go vertical with multifamily development. Obviously, COVID put a damper on that project plan, but our client was able to get out just in the nick of time with that amazing offer. And what we did with that $3 million 1031 exchange was the first component. We found a brand new Popeyes located in the core downtown Houston area. For those of you that are familiar with Houston, Texas, this Popeyes was located off of Bel Air Boulevard, and that's a major thoroughfare out in the Houston region. It was a huge operator, one of the largest franchisees of Popeyes in the entire country, and they got a brand new 15-year triple net lease at a 5% cap rate in an ultra-high density location in Houston, Texas, and that encompassed about $2 million of the exchange. And with the net proceeds, the clients decided that they were going to acquire a portfolio of manufactured homes in Houston, Texas, and that significantly bolstered the portfolio's overall return, and they went from $6,000 per year in net income to just over $200,000 in net income. And you have to remember, in the triple net lease, the tenants are paying for all of your property expenses, including taxes, insurance, and management and maintenance. So very unique scenario, but the clients being an elderly couple that frequently go back and forth from LA to Hawaii, we're very happy. And as you can see in the illustration, in the breakdowns of cash flow and actual expenses, that $200,000 will go a very long way for the retired couple, and they are extremely happy as well to be able to get that added cash flow. So in the next situation, we had two brothers who had sold an Italian restaurant out on Main Street in Alhambra As you guys know, the restaurant industry is very volatile, or can be volatile, and during circumstances such as COVID-19, it could put a huge damper on your business. And we're all trying to troubleshoot and figure out how to get out of here A-OK. The clients did this 1031 exchange last year and decided to do a sale leaseback on their Italian restaurant. And what they did was they decided to acquire a portfolio of rentals that would help them fall back on passive cash flow, so that in case they wanted to sell their restaurant one day, they could benefit from the rental properties. And so what we did was we found a Pizza Hut that was the second largest franchisee in the United States with over 250 stores, and they would be guaranteeing this 20-year absolute triple net lease that had annual increases. We got this deal at a 6% cap rate. And having looked taken a deep dive into their financials, the store location was performing very well, and we actually acquired this for just over $1.7 million. With the remainder of the portfolio, we decided to diversify and go out of state, and so we acquired 19 single-family rentals in Indianapolis and Houston. And so what they used to pay themselves as part of their rental income for their business at $95,000, they were able to increase their cash flow and go into the overall portfolio that was generating $152,000 in net income per year. So that's going from a 4% cash flow to a 9% cash flow. And that's definitely activating their capital much more efficiently. And so these two brothers to this day are still holding on to this portfolio with no intentions of moving it whatsoever. So here's an example of a smaller 1031 exchange. We had a longtime client that decided to sell their luxury condo, or I'm sorry, their oceanside condo in Long Beach. And this was a historic building. It had a very small studio space, but we were tasked to list this property on the MLS, and we sold it for just over $300,000. And at the time, she was getting about a 3% cap rate based on the sales price and the rents she was generating from this studio. And what we did was we converted this single studio into 6 manufactured homes in Houston, Texas, and we doubled her cash flow from $15,000 per year in net income to just over $30,000 per year in net income. And that's going from, for argument's sake, of just over a 5% cap rate into an 11% cap rate portfolio. And now she's increased her overall unit count from 1 to 6. And with the illustration, just over 11% cash flow. Here's another 1031 exchange example where a client of ours sold a property and acquired a portfolio of single-family homes in Beaumont, Texas. These homes, just like our Indy homes and our opportunity in Beaumont, are fully remodeled, fully rehabbed, placed with a tenant, and they performed at an overall blended cap rate of 9%, which is just shy of $89,000 per year in net income. The portfolio consisted of 8 homes, and we have excellent property management teams that serve as our boots on the ground, and we acquired this portfolio for the investor at $979,000, which is probably 1 or 2 homes here in LA at most. But as you can see from the cash flow analysis, the market in Beaumont is very robust, and the cash flow is performing at just over a 9% cap rate, which is far superior than what we're seeing here in California. So, and finally, this was a property that I was really proud of securing for our client. We were looking for commercial triple net lease properties for over 3 months, and my client had liquidated her stock portfolio right before COVID-19, and which was a great move in retrospect. But what we found through our developer-broker relationships was an in-and-out building located right off the 10 freeway in Yucaipa. And it was a 2-tenant asset that had 20-year triple net leases, and we negotiated it from just a high 3 cap to a 4 and almost a quarter cap rate. Building was built in 2016, and when you have a tenant like In-N-Out who does more than $4 to $5 million in sales per location, this was an absolute steal. This tenant is not going anywhere, and we were able to negotiate it through just our relationships and the buyer being a very strong, bona fide buyer. We negotiated it $300,000 below asking price, and acquired this In-N-Out and the adjacent tenant for $8 million. And we just found out a few weeks ago that Kaiser Permanente will be breaking ground across the street, which is going to significantly increase the demand to be in this location should any of these tenants, God forbid, decide to vacate. So it was a great real estate play. Yucaipa is a growing area. You won't miss it if you're driving on your way to Palm Springs. But the important story here is that in finding this deal, which you rarely see In-N-Outs on the market, period, client's very happy, and it's definitely a legacy trophy asset, and we can check that box as far as fulfilling their criteria. So, yeah, that was a fun deal. And we wanted to show you guys that during COVID-19, even though at peak COVID times, peak pandemic times, these QSRs, or quick service restaurants, are very resilient in these times because of the fact that they have a drive-through component. And even during peak COVID, this drive-through was literally packed around the block. This is the In-N-Out location that's just 2 to 3 minutes away from our offices, and as you can see here, completely packed. And so this is why we like this type of asset as a conservative play. We were already anticipating it prior to COVID-19, and we're very proud to say that none of our restaurant acquisitions for our clients had any lapse in payments during COVID-19. So very proud of that as well.
Great. Thanks, Edward. Yeah, and again, we've been doing this strategy now for the last 4 years, and it's held up fantastic through this whole situation we're going through this year. But again, when you look at the big picture, there's been a shift in the markets for a while. It's just being accelerated with what's happening today. And back to our map here. And again, I'm sure you guys all know somebody that's been talking about moving or has moved, or some family member or friend or whatever. But there's example after example of what's happening. I was actually in my attorney's office here in Glendale a couple months ago, and he had a list on the wall of people, and I'm going, what the heck? There's like 15 or 20 people on that list. Why do you have it on the wall? And he goes, those are all clients of mine that have either moved or about to move out of Los Angeles. And so I was kind of surprised at that, actually. But again, there's a lot of things happening in these other markets. I personally just bought a building, a commercial building in Clearwater, Florida, and that market's really perked up a lot. In fact, the building I bought, fortunately, we got it through a loan committee and got it all approved and everything. But if I hadn't, there was another offer right behind me at 25% higher than what I was buying it for. And so again, there's a lot of markets where the activity is actually very strong. And so we want to take advantage of that going forward. And the markets we've been showing you, ones that we are very familiar with, we've got a good inventory available. It's not listed properties. These are properties that are off market through networks that we have. And also we have very good management in place. Again, we've shown you some big properties, some little properties. I mean, we just closed on one today, a manufactured home for $40,000 for a client of ours in their IRA. We do a lot of business in retirement accounts that you can do these in, but you may just want to buy a property on your own, or it may be an exchange. Again, we have a whole range of scenarios, for just about everybody. So if anybody has any questions, don't hesitate. You can email us at tfsproperties.com. You can call us. We do free consultations. You can go on to our website. We have a lot of information on there. We have some other videos. Again, we're very, very active right now. I think we're doing probably the most transactions I've seen since back in 2009 prior to 2009. Back in 2006 and 7, it's probably the busiest period of my entire life in the real estate world. And obviously it dropped off quite a bit after that. But right now we're not quite as busy as back then, but we're almost. This is definitely the busiest I've seen it in 10 years. And again, there's just a lot of shifts and a lot of things happening. And so we want to be in the right side of the equation. So again, if you have any questions or any interest in what we've been talking about today, don't hesitate to either email us or call us. My staff is really good. I have a great team here. As you can see, we do a lot of 1031 exchanges, and we have for many years. So we're very, very familiar with all the ins and outs and how to do that correctly. We have a lot of good clients we're dealing with right now. Believe it or not, we have one portfolio we're putting together for a client for $15 million as part of an exchange. So we're very busy, but we have a great team here. We can handle it all. So again, hopefully we'll hear from you folks down the road. But yeah, thank you very much for listening in. Hopefully you found this information valuable. And we plan on doing another one of these updates probably in the next month after New Year's. So if I don't hear from you guys, have a great Christmas and Happy New Year's, and everybody stay safe. Thank you.